Hello. I want to thank you for coming to this presentation at the CTA Expo in New York. I want to thank Bucky and Frank and Jamie for having me and being able to present you these ideas that I've basically worked on over the last 20 years. This is a little bit of background about myself. I'm a commodity trading advisor. And I think that's prevalent to or pertinent to our conversation is I've been investing in CTAs since 1994, as well as I'm an author. I've written several books, and actually I've been fortunate that Mark Faber wrote a short review on my last book, and actually you can pick up the book on Amazon, or actually if you'd like, I can even email you the book for free for those of you that are participating in the CTA Expo. The goal of our discussion is really how to create and maintain wealth by investing in managed futures over time. We're going to discuss in our short presentation here three main principles: guidelines for investing with world-class money managers, the reality of what to expect when you invest, and then what I call it focuses really on the compounding aspect of the monies that you possibly can generate over time. But I also want to give the full disclosure that past performance is not indicative of future performance. And when you're investing in managed futures, the goal isn't just making money. To me and to others that have made presentations here today, such as Tano Capital, that you need to be aware that managed futures as an asset class stands the potential to offset the threat of inflation. And actually I was fortunate to listen to Paul Singer from Elliott & Associates. And for those of you that are not familiar with him, he's been around since the 1970s. He has $16 billion under management. And he stated verbatim, the thing that scares me the most is significant inflation, which could destroy our society. Just using common sense with all this money that's been printed, it scares me. And this is why I've invested a large percentage of my net worth in managed futures. But it's never been easy. In all truthfulness, the last 2 years for managed futures have been very, very challenging. They've been long, and they've been losing periods. And the reality also of these two last years, 2011 and 12, have been subperformance and negative performance. I repeatedly heard that trend following is dead. I even received an email from a potential client telling me, find a new line of work. Well, what I say to this is this. I've been doing this since 1994. As much as past performance is not indicative of future performance. It's never easy. There's always losses. There's always long drawdowns. But the crowd always gets it wrong. Like on this slide, you see the death of equities. This was the cover of Business Week in 1978 or 79. And for those that know market history, the stock market had the biggest bull market ever right after that. And if I want to look at the scenario we're having right now, you're having many famous, or let's say marquee managers are closing that have been around for decades. They're closing. In my own testing of trading systems and building mechanical trading systems, the worst drawdowns have been anywhere between 25 and 30 months. Well, as much as the drawdowns can go on because we're only dealing in uncertainty, and the other fact is we can have continual losses, statistically, when we have 25 to 30 months, these drawdowns end or have ended in the past. What's very interesting to me is many investors who even invested with successful money managers lose money. what they're doing, they do the wrong things. They invest when a manager has a good run. When he's up 10, 20, 30%, they invest with him. They think they're safe. They're buying the highs and selling the lows. On the same tangent, it's very easy to allocate to a money manager who's large. Let's say a John Paulson, a Winton, a Lynx, because you feel they're safe. But those that really understand what goes on in the markets, they realize that's a fallacy. With John Paulson, well, he has had amazing, great returns and some very severe drawdowns. As I said, there's three aspects in which I want to discuss. And one of the main points I want to discuss is, as in my trading, which is rule-based and systematic, I have rules when I allocate on the behalf of my family into what I'll call world-class money managers. And let me first qualify that. I went to lunch, actually, the other day while I was in New York with a manager who actually has had a compounded annual rate of return of about 18% since 1988. If you want to compare that to Warren Buffett, who many people think is a world-class money manager, he has a compounded annual rate of return of about 3.62%. So there's a very small, unique group of CTAs that I personally feel understand risk, and I also want to, put the cards on the table. They will still have drawdowns, ugly drawdowns. They will still have periods they lose money. But then there's other times, over time, they've been able to compound money that is much greater than 15%. So I have rules. My rules are very simple. I want to see a 10-year track record of the manager because he's seen various cycles. I want it to be liquid and transparent. You need to have a managed account. You alleviate a lot of problems and a lot of potential fraud. I'm looking for a 15% compounded annual growth rate. What I do, I watch the managers, and invariably, every manager is going to have a drawdown. Invariably, every manager is going to have an ugly period. I use those as entry points. Or as Tom Basso said from Trend, buy the CTAs on sale. That's what I try to do. And again, it's not perfect. I use strong due diligence. And actually in the book, The Bible of Compounding Money, I talk about this due diligence, all the qualitative due diligence. And then as much as I know that we're dealing in complete uncertainty and any manager can blow up or have a problem, I don't allocate more than 5% of our assets in any one manager. I accept the fact that nothing is perfect. There is no magic manager, no magic system, and that even following these simple rules, they're not perfect. There'll still be losses, and the manager can still, fail or blow up. Where to find these world-class managers? Well, guess what? You're lucky to be sitting in this audience and being a part of the CTA Expo. And I would suggest you go to all of them. I do. You meet managers. You meet investors. It's a great way to network. What I do suggest to you is never, ever, ever just chase returns. And unfortunately, people do that. They look at these databases and they chase returns of the newest and hottest managers. It's a recipe for disaster. The next couple slides I'm presenting to show you what I call a couple things. Pieces of the puzzle, and it goes back to one of the three goals. This is the second goal. What to expect when you invest in a commodity trading advisor. And you know what I'm going to tell you? It's not easy. And I made up a presentation one time, and it's called How Easy It Isn't. This is an example where you had a nice run up, and then the first year, nothing happened. No profits. And unfortunately, everyone's looking, what can you do for me now? Well, let me explain to you. Investing in managed futures is a marathon. 60-70% of the time, nothing happens except drawdowns and losses and flat periods. This is real time. This is a real trading account. The other thing to anticipate with a real trading account is you will have ugly, steep drawdowns. I traded this and I was down 30% at this point here. And then you'll have long periods that nothing happens, or what I'll call elusive profits. And once you realize that this is what you have to anticipate in order to succeed potentially, it puts you in a better frame of mind work, that you don't just buy the highs of a manager and then sell when he has a flat period or a drawdown, because invariably both will happen. He will have losses, no matter how good he is or she is, and flat periods. What I want to show in these next slides is the proof of concept. These are managers, and I'll say they're a unique group of CTAs. They're not, let's say, commensurate of every CTA, because most CTAs don't succeed. These are a very small group that have been around for decades and that have compounded at very nice rates of return. And as I believe in every field, if it's music, is it dance, is it football, you only have a very small, unique group of people that have talent. And these are the ones that have some talent. But I'm going to tell you, to make it balanced, there is no holy grail with any of these managers. Each and every one of these managers that had unique and interesting compounded annual rates of return over decades, look at these drawdowns you'd have to go through. 31%, a 36%, 27%, 40%. This is reality. And that's why I suggest to you to try to buy the drawdowns of these managers. And even that's not perfect. There is no perfect. You will still have losses and managers will close. If you look on this, let's say, 13-column approach, it's not a 13-column, it's just a return from ISAG, there's periods that are phenomenal, and there's periods that are just downright ugly. But the idea is to stick with a manager over long periods of time and try to compound money. Like, who wouldn't want to compound here? 48%, 28, 43, 12, 1, 61%. That's great. But then what do you do here when you lose 11% and you lose 17%? These are realities. It's never easy. There's always losses, no matter how good the manager is. Here's another example. Down 32%, down 18%, down 13%, down 14%, down 10%. But then you also have wonderful periods. I mean, it's shocking. 65%, 21%, 17%, 14%, 17%, 17%, 46%. The idea is to be available for these. Because the other fact is, if you exit on the first drawdown or on a drawdown, you don't stay in the marathon. Drawdowns are inevitable. Even the most successful CTAs that I know and that I've invested with personally, that even understand risk management, money management, and proper trading psychology, they're not gurus. They're going to go through ugly periods of trading. And the irony is, even these managers that have compounded these tremendous amounts of money, the vast majority of their investors did not achieve their success. They jumped ship at the first drawdown, or they got bored, or they bought the highs and sold the lows. Again, what I suggest is, and it's not perfect, try to invest during the inevitable drawdowns. This is really what I do. I'm going to give you what I believe is the mantra. Reasonable returns. I'm not saying hitting the ball out of the park. Reasonable. You need time. You need the power of compounding. And you can create extreme wealth. There was an article written in Marhedge magazine in 2003. And what it spoke about was with Tom Shanks with Hawksbill Capital. And what's ironic here, you can kind of see right here, his first client put $300,000 in 1988, despite redemptions of more than $1 million, This client account has grown without further additions to over 18 million. But don't think that it was easy. As I said, drawdown 24%, 27%, down 29%. Actually, the drawdown of Hawksbill, his worst drawdown, if I'm not mistaken, was close to 60%. But this investor hung in there. So what's really important here is remember this: reasonable returns, time, the power of compounding potentially can create extreme wealth. In this example, from this article, and I can email you the article, just email me at andrew@abrahamcta.com, and I'll send you this article. It has nothing to do with me. It's just a fact that happened in 2003. That this gentleman basically turned $300,000 into about $19 million in 2003. And if you want to fast forward another 10 years, and I'll make a disclosure that I've invested with Hawksbill myself, that account is worth approximately $30 million today. This is the reality. But it's a unique reality, because the fact is many CTAs fail. However, there are a few unique, select, what I'll call, in my interpretation, world-class money managers with audited, real-time numbers who have compounded money. But they're not perfect. They have losses all the time, and they have long periods that they don't make money. In every field, whatever you do, if it's an accountant, if it's football, if it's baseball, if it's, you name it, there's always a small handful of unique and talented people in whatever field it is. And in my interpretation, I want to be invested with those people. Sports, music, art, you name it. Here it is. Again, I invite you to learn more. I will gladly give you my book for free. It's on Amazon. If not, it's called The Bible of Compounding Money. And really what it does is it chronicalizes from 1994 how I've invested with what I'll call world-class money managers. And I'll tell you right now, it's not easy. Again, there's drawdowns, there's long durations of drawdowns. But if you can stay in the marathon and have an open, let's say, expectations that are not irrational, you stand the potential to compound money. And that's really the goal. My goal, and Bucky asked me to speak here, to teach you or to enlighten you what to expect when you invest in CTAs. Don't think it's easy. What I suggest strongly are those rules that I presented earlier in this presentation. And if there's any way I can help you, contact me. Here's my contact details. I'm a CTA myself, as well as I've invested in them with the sole goal of compounding money over long periods of time. I had a mentor who started in 1979, who was a dentist. I learned from him how to think, how to approach the markets, how to be patient, how to be disciplined in order to compound money, potentially over time. Again, thank you very, very, very much for attending my presentation. I really hope it was enlightening and I gave you this aha experience. It's really, that's my goal, is to share. People have helped me all along, and my goal is to help you. Thank you again. I greatly appreciate it.